Welcome. My name is Michael Quinlan. This program covers investment companies. When many people are just starting an investment program, they often find that lack of a large amount of capital makes it difficult to create a balanced, prudent investment program. However, by pooling their resources with other similar investors, small investors find that they can enjoy many of the same benefits otherwise available only to those with large amounts of capital. This is the principle behind an investment company. For many, investment company products are the ideal first step in an investment program. One of the important features that an investor is looking for is diversification. If an investor, for example, purchases the common stock of only one or two companies, bad results for those companies can devastate a portfolio. By spreading out this risk over many companies, the risk of large losses due to bad results of one company is greatly reduced. Investors with lots of capital can also purchase securities with large denominations. For example, pass-through securities issued by the Government National Mortgage Association, or Ginnie Mae, will issue minimum increments of $25,000 face amount. Many securities in the money market trade in issues of $1 million or more. By pooling resources through an investment company, small investors have access to such securities. Small investors may lack the time and inclination to actively monitor and manage their own investment portfolios, but hiring a professional money manager is often not possible for many investors. Many money managers will only accept clients with large amounts of assets. Investment companies can afford to hire professional managers to supervise the investments of many small investors. And since small investors are often not familiar with securities and how they are traded, Congress passed the Investment Company Act of 1940 to try and ensure that these investors are treated fairly. This law defines three types of organizations as investment companies: face amount certificate companies, unit investment trusts, and management companies. A face amount certificate company, as its name indicates, sells savings certificates with a specified face value. The certificates mature on a specific date. The purchase price for the certificate is less than the face value. When the certificate matures, the investor receives the full face amount. The difference between the purchase price and the face value is interest. Investors can purchase face amount certificates with lump sum payments or in installments. The certificates can also be redeemed before maturity for current surrender value. Face amount certificates are not a significant factor in the market today. A second style of investment company is a unit investment trust, or UIT. This type of investment company is set up by a sponsor who is often a broker-dealer. The sponsor creates a trust and places it in a variety of securities, usually all of one type, such as a selection of municipal bonds. The sponsor then sells interest in the trust to investors. Now, these are called shares of beneficial interest. Now, let's suppose as an example that the trust contains a variety of municipal bonds. As the bonds pay interest, it is collected by the trust. The trust then passes through a pro rata share to each investor. In addition to the payment of interest on the bonds, each bond will eventually mature or get called. As this occurs, the principal is collected by the trust holding the bonds. However, a key feature of the UIT is that there is no manager to reinvest the principal in a new bond. The trust simply passes the principal through to its investors on a pro rata basis. Eventually, all of the bonds will mature or get called, and the trust will gradually liquidate itself. If the trust becomes inactive, the SEC has the power to liquidate it. An investor who does not want to wait until all of the bonds in the trust are paid off can redeem the units or sell them in the secondary market. However, the secondary market or redemption value may decline due to a drop in the value of the bonds in the trust. While unit investment trusts are a popular type of investment, the most common type of investment company is the management company. The management company, often called a fund, is usually set up as a corporation or business trust. It has a board of directors or trustees that oversee the operations of the company. The funds sell shares in itself to investors. Their capital is then invested in a portfolio of securities. Securities are chosen for the portfolio that conform to the fundamental investment objectives of the fund. These fundamental objectives cannot be changed without the approval of the fund's shareholders. The shareholders also have the right to elect the board of directors. The choice of which securities to invest in is made by the investment advisor or manager. The manager is a registered investment advisory firm hired under contract by the fund to professionally manage the fund's investments for a fee. Many funds also sell their shares through a group of broker-dealers acting as underwriters. They earn a commission or sales charge for their efforts. In many cases, members of the board are also affiliated with the investment advisors or underwriters. To protect the interest of investors, a majority of the board must be outside directors, that is, not affiliated with the investment advisors or underwriters. While the Investment Company Act of 1940 has three main categories of investment companies, management companies are further classified into closed-end and open-end companies. Now, these types differ in how the shares are sold and the way that the fund is capitalized. We will examine closed-end funds first. The shares of a closed-end fund are usually sold in a typical firm commitment underwriting. First, the syndicate purchases all the shares to be sold from the issuing fund. Then the syndicate resells the shares to investors at a slightly higher price, earning its profit or spread. The underwriter's job is now complete and they perform no further function. As an example, suppose that the ABC Fund Incorporated, a new closed-end fund, proposes to sell 10 million shares to investors. The underwriters buy all 10 million shares from the issuer for, let's say, $9.50 a share, and then resell the shares to customers for $10 a share. The underwriter earns 50 cents per share, and the underwriter's job is now finished. And the fund now has a fixed amount of capital to invest. However, what happens if later investors want to sell their shares of ABC Fund? Since the fund does not stand ready to redeem the shares, they must be sold to other investors in the secondary market. The price of the shares in the secondary market is set by supply and demand. Closed-end fund shares are traded both on exchanges and in the over-the-counter market. They are therefore also called publicly traded funds. Transactions for closed-end funds usually involve a commission. While the market value of a closed-end fund is set by supply and demand, we can calculate a theoretical value for the fund shares. For example, here is ABC Fund Incorporated with its 10 million shares outstanding. ABC's assets consist mainly of the securities in its portfolio, which today, let's say, they are worth $121 million. Suppose the fund has liabilities or debts of $1 million, a difference of $120 million, which are the fund's net assets. When divided by the 10 million shares outstanding, we have the number called net asset value per share, or NAV, which is, in this example, is $12. It tells us what we, in theory, would receive per share if a fund sold all of its portfolio securities, paid off its debts, and distributed the remainder to shareholders. It is important to distinguish a fund's NAV from its market price. A closed-end fund's NAV is calculated from the value of its assets, while the market value is set by supply and demand. The net asset value is not necessarily the same as the fund's market value. A closed-end fund's market value may be higher than, equal to, or lower than its NAV. Let's look at some examples. Information about a closed-end fund is available in many newspapers such as the Wall Street Journal. Here is information about one such company, the Royce Value Fund. Now, this table shows the NAV on one particular day to be $13.48. However, the market price for the fund is $12.88 per share. This is 4.5% less than the fund's NAV. Now, this fund would be said to be trading at a discount. The Mexico Fund is another example of a publicly traded fund. On this day, it had an NAV of $37.78, while its market price was $39. The market price is a 3.2% premium over net asset value. Closed-end funds then have a relatively fixed capitalization. That is, they issue a fixed number of shares rather than issuing shares continuously. They can, however, issue bonds or preferred stock to raise additional capital. The second subcategory of management companies is the open-end management company, which is also called a mutual fund. One of the key differences between open-end funds and closed-end funds is the way that they are capitalized, that is, the way that the shares are sold. And recall that closed-end funds issue a fixed number of shares that then trade in the secondary market. Open-end funds, on the other hand, will continuously issue new shares. This enables them to raise new investment capital on a continuous basis. However, mutual funds also stand ready to redeem existing shares. Redemptions will cause the capitalization of the fund to shrink. Note that on some days, more new shares will be sold than redeemed. Now, this would cause the fund's capitalization to grow. On other days, more existing shares are redeemed than new shares are sold, causing the fund's capitalization to shrink. While mutual funds may not issue bonds or preferred stock, they may borrow from banks up to 1/3 of their assets. The redemption of mutual fund shares is based upon net asset value. Shareholders received the next NAV calculated after their redemption request is properly submitted or tendered. The fund must pay redemption requests within 7 calendar days. The net asset value of a mutual fund is calculated in the same way as that of a closed-end fund. Liabilities are subtracted from assets, and that amount is divided by the number of shares outstanding. The result is net asset value per share. In some cases, investors redeeming shares will not receive the entire NAV. Certain mutual funds will assess a small redemption charge, which is deducted from the redemption proceeds and put back into the fund's portfolio. A redemption charge is not the same thing as a back-end sales charge, which will be discussed later. Now, let's look at an example of mutual fund redemption. If an investor redeems 500 shares when the next NAV calculated is $12.80, what would the investor receive? We would multiply $12.80 per share times the 500 shares being redeemed. This produces $6,400. Suppose that the fund in the example, though, charged a 1% redemption fee. How much would the investor then receive? Well, once again, we would multiply 500 shares by the NAV of $12.80, which is $6,400. 1% of $6,400, or $64, would be deducted as a redemption fee, leaving $6,336. Since net asset value is used in the computation of the redemption proceeds, it is also known as the bid price or the redemption price. Mutual funds also differ from closed-end funds in the way that shares are sold to investors. Since a mutual fund can continuously issue new shares, they cannot be sold through a normal firm commitment underwriting as a closed-end fund can. Instead, one brokerage firm called the sponsor, distributor, or principal underwriter acts as the manager for a permanent group of brokerage firms that will sell shares of the fund to their clients. These brokerage firms are called dealers. When a customer submits an order to the dealer gives the order to the sponsor, who purchases shares from the fund at NAV. The sponsor then sells the shares to the dealers and to the customers at a higher price than includes a sales charge. In some cases, the sponsors sell shares directly to the customers without using a dealer network. Some funds sell their shares directly to investors without using the services of any underwriters. In many cases, investors who purchase mutual fund shares pay a sales charge at the time of the purchase. This is called a front-end load. The price that the investor pays is called a public offering price, or POP. The POP consists of the current net asset value of the fund plus a sales charge. The net asset value is invested in the fund's portfolio, while the sales charge is deducted to pay sales expenses such as commissions to dealers. Recall that some funds distribute their shares directly to customers without using a sponsor or dealers as intermediaries. Since there are no sales expenses to pay, these funds have a public offering price that is equal to the net asset value. There is no sales charge assessed. This type of fund is called a no-load fund. Let's look at an example of a front-end sales charge. And recall that the public offering price is equal to the NAV plus a sales charge. Now suppose that the public offering price is $10, which consists of NAV of $9.50 and a sales charge of 50 cents. To see the relationships, imagine a $10 bill, which represents the public offering price. This amount can be broken down into its two components. $9.50 of the total is invested in the fund's portfolio at net asset value, while 50 cents of the total is used to pay distribution expenses. It is often helpful to think of the sales charge as a percentage of the total public offering price. This is calculated by dividing the dollar amount of the sales charge by the total public offering price. In this example, the sales charge of 50 cents is divided by the $10 public offering price, yielding a sales charge of 5%. Although the percentage sales charge assessed from day to day is constant, the actual dollar amount of the sales charge will change as the NAV also fluctuates. Each mutual fund must reprice its shares at least once per day based on the current net asset value of the portfolio. Now, how is the new sales charge and public offering price determined from net asset value? Now here again is our previous example. The 50 cents sales charge is 5% of the public offering price of $10. This means that the NAV of $9.50 is 95% of the total public offering price. Now, suppose that the NAV is updated and is now $9.75. What will the new sales charge and public offering price be? Well, the dollar amount of the NAV and the sales charge will change, the percentage of each will not. The sales charge will still be 5% of the public offering price, and the NAV will still be 95% of the total. We could then calculate the new public offering price by noting that 95% of that public offering price is equal to $9.75, the new NAV that was just calculated. Therefore, the new public offering price will be equal to $9.75 divided by 95%. The new POP is therefore $10.26. Since the new sales charge is the difference between the sales charge and the NAV, it must now be $10.26 minus $9.75, or 51 cents. In general, if one knows a mutual fund NAV and percentage sales charge, the public offering price can be calculated by dividing the NAV by 100% minus the percentage sales charge. The percentage sales charge assessed by a mutual fund is set in the prospectus. The same amount must be charged to all investors. However, a mutual fund is allowed to assess a lower sales charge on large purchases. The dollar amount at which lower sales charges are granted is called a breakpoint. Now, here is the breakpoint scale for a hypothetical mutual fund. The larger the amount purchased, the lower the sales charge. To illustrate how a breakpoint scale works, consider a customer who wants to purchase $75,000 worth of XYZ fund shares. And what public offering price will the customer pay if the NAV is $9.50? We know that we can determine the public offering price by dividing the fund's net asset value by 100% minus the percentage sales charge. The NAV is $9.50. To determine the relevant percentage sales charge, we note that the customer is purchasing $75,000 of the fund, which is between $50,000 and $100,000 of fund shares. This amount qualifies for a reduced sale charge of 3%. So we would divide the NAV of $9.50 by 100% minus 3%, or 97%. This gives a public offering price of $9.79. If this investor did purchase $75,000 of fund shares under these conditions, how many shares would be purchased? To determine this, we would divide the amount invested by the public offering price. In this case, the $75,000 invested is divided by the public offering price calculated at the reduced sales charge level, $9.79. This is equivalent to 7,660.878 shares. Mutual funds will calculate and sell fractional shares up to 3 decimal places. Our hypothetical mutual fund charges a maximum sales charge of 5%. However, NASD regulations permit funds to charge up to 8.5%. But such a fund would have to offer its investors 3 specific benefits. First, it would have to offer specific breakpoints to its investors for large purchases. The first breakpoint must be at $10,000. Second, the fund must offer its shareholders a privilege called rights of accumulation. To illustrate the concepts of rights of accumulation, consider again the breakpoint scale for XYZ fund. Suppose an investor purchases $5,000 worth of XYZ fund. Since this is below the first breakpoint, an XYZ sales charge of 5% will be assessed. Later, the investor makes another purchase for $6,000. Under rights of accumulation, the sales charge to be assessed could be based on the total purchases made so far, $11,000. This would result in a 4% charge on the second purchase, since $11,000 is above the first breakpoint. Some funds use the current value of existing shares plus the new purchase to determine the sales charge. The rights of accumulation must be offered for at least a 10-year time span. In addition to offering breakpoints and rights of accumulation, funds that charge an 8.5% load must also provide dividend reinvestment at NAV. Since funds continuously issue new shares, shareholders can elect to have earnings reinvested in new shares rather than paid out in cash. If dividends are allowed to be reinvested at NAV, no sales charge will be paid on the reinvested amounts. However, customers must realize that the amounts still have to be reported as income even though the investor received no cash. If a fund wishes not to offer any one of these 3 features, it may not have an 8.5% sales charge. For each feature deleted, the fund must have a sales charge subject to a lower ceiling. For example, if a fund does not wish to offer dividend reinvestment at NAV, it may not have a sales charge higher than 7.25%. Many load funds offer another optional feature that can help reduce sales charges. Let's say an investor will probably make 2 purchases of XYZ fund in the near future. The investor plans to make the purchases within a 13-month time frame. Although each purchase individually would normally be subject to a 5% sales charge, the total of $11,000 would qualify for a lower 4% charge. If available, the investor could sign a letter of intent. Under such a letter, an investor who intends to make 2 or more purchases during a 13-month time span can qualify for reduced sale charges based on the total amount to be purchased. Unlike rights of accumulation, the lower sales charge is applied to every purchase made during this period. In this example, this would be a 4% charge on both purchases. Suppose, however, that the investor makes the first purchase at the 4% level, but does not make the second purchase, which is necessary to qualify for the reduced charge. In this case, some of the shares from the first purchase will be redeemed and kept by the fund. These shares will be held in escrow, pending completion of the letter of intent. By taking them back if the letter of intent is not completed, the fund reimposes the higher sales charge, but the investor is no worse off than if the letter had not been signed. We have seen that the public offering price charged by a traditional front-end loaded fund is split into 2 parts. The manager invests the net asset value in the fund's portfolio. The remaining portion, the sales charge, is used to pay distribution expenses, such as commissions earned by the sponsors and dealers. In a traditional fund, distribution costs could not be paid out of the fund's portfolio. They were paid only by money being contributed by new investors. Today, however, some funds pay distribution costs in a different manner. Money is deducted from the fund's portfolio to pay distribution costs rather than being deducted as a sales charge up front. These distribution costs include things like commissions paid to sponsors and dealers. These types of deductions or distribution expenses are known as 12b-1 charges. Let's address some of the key features of 12b-1 charges. First, they are assessed as an expense charge against the mutual fund's portfolio. They are therefore charged on an ongoing basis and affect all shareholders, not just new investors. They are used to pay distribution costs. These include the costs of creating and distributing sales literature, payments for sales commission and service fees, as well as sales support services. In order to assess 12b-1 charges, a plan must be filed with the SEC and approved by shareholders. The plan would indicate the level of charges and how they would be used. The plan would also need to be reviewed quarterly by the fund's board. As an alternative to the traditional front-end load charge, some funds now assess a sales charge when an investor redeems shares. These types of charges are sometimes called back-end loads. Since the amounts of the sales charge often depends on how long the investor has held the shares being redeemed, they are also known as contingent deferred sales charges. In such cases, investors purchase shares at NAV with no sales charge deducted at the time of the purchase. And later, when the investor redeems shares, the redemption value would be the net asset value minus a possible sales charge. To determine the amount of the charge, if any, we would consider how long the investor has owned the shares to be redeemed. Here is an example of a contingent deferred sales charge scale. Note that the longer the shares are owned, the lower the sales charge assessed when the investor redeems them. If an investor holds on to the shares for a long enough period of time, no sales charge is assessed upon redemption. The deferred sales charge may be based on the original price of the shares or on their current value. Contingent deferred sales charges are often used in conjunction with 12b-1 charges. If an investor holds on to shares for a long enough period of time, the relatively small 12b-1 charge, since it is collected each year, will pay the distribution costs involved in the sale of the shares. However, if the investor redeems shares quickly, the distribution costs will not have been recouped through the 12b-1 charges and will be made up through the contingent deferred sales charges. Investors who purchase mutual fund shares want to know, of course, what type of returns they will earn from their investment. Income earned on the securities held in the portfolio is one source of these returns. If the portfolio contains stock, dividends might be received from them. Bonds held in the portfolio will pay interest to the fund, and dividends and interest collected on the portfolio securities are called investment income. From the investment income, the fund pays various expenses such as the management fee to the investment advisor and any 12b-1 charges. The amount remaining is called net investment income. At this point, an ordinary corporation would have to pay taxes on its profits. However, a mutual fund can avoid paying taxes on its income by following rules of Subchapter M of the Internal Revenue Code. Under these rules, the fund must pay out to shareholders at least 90% of its net investment income. This is paid to shareholders as a mutual fund dividend. Shareholders are then responsible for reporting the income on their tax returns in the appropriate manner. Another source of return from mutual funds are the profits earned from the sale of securities in the fund's portfolio that have appreciated in value. For example, consider a specific security in the fund's portfolio. Now, suppose that the manager originally purchased the stock for $50 a share. Later, the manager sells the stock for $70 per share. The increase of $20 per share is a capital gain. Capital gains are not included in investment income, but are determined separately. These gains are then paid to shareholders and are identified as being long-term or short-term. These payments are called capital gains distributions. Dividends and capital gain distributions are reported at the end of the year to the investor and to the IRS on Form 1099 DIV. The figures on the form are then transferred to the investor's tax return. Some mutual fund investors will receive another form at the end of the year, a 1099-B. This form represents the proceeds received by mutual fund investors who have redeemed shares. The investors must use this information to determine the capital gain or loss on the redemption of the shares. In addition to this information, the investor must determine the cost basis of the shares sold. If the difference between these two figures is positive, the investor has a capital gain. If negative, a capital loss. But how is the investor's basis determined? Now, here's the account of an investor who has been purchasing mutual fund shares over a period of time. We are assuming purchases at NAV. This investor now decides to redeem 100 shares when the net asset value is $15 per share. Since the investor has made several purchases, which shares are being redeemed and what is their cost basis? Since most mutual funds do not actually issue certificates that can be identified, the Internal Revenue Service assumes that the shares being redeemed are the first ones purchased. This method is known as first in, first out, or FIFO. In this case, the cost basis used would be $10 per share. The investor, however, can elect to use a different method of determining basis. For example, the investor can write a letter to the mutual fund identifying by purchase date the shares to be redeemed. For example, the investor might identify the most recently purchased shares as the ones to be redeemed. The advantage of this is that their high cost basis will result in a lower taxable capital gain. This technique is called the identified shares method. Another optional method of calculating basis is the averaging method. With this technique, the investor calculates the basis of the shares redeemed based on the average cost of all of the previous shares purchased. The average cost is equal to the total amount invested divided by the total number of shares owned. In this example, the total amount invested, $4,000, is divided by the number of shares owned, 350. The average cost is then $11.43. While an investor has some choices for how the cost basis of shares is determined, once a particular method has been chosen for a specific account, it must continue to be used for that account in the future. Many of the characteristics and features of a mutual fund can be found in its prospectus. For example, here is the cover of a prospectus for the hypothetical XYZ mutual fund. The first paragraph states that XYZ is a diversified and open-ended management company with a primary objective of long-term growth. Income is a secondary objective. The fund invests mainly in the common stock of larger companies. The term diversified is used in a very specific sense. In order to call itself diversified, a mutual fund must have at least 75% of its assets in cash, government bonds, and securities invested in such a way that the securities of any one issuer take up no more than 5% of the fund's total assets when initially invested. In addition, the fund cannot own more than 10% of the voting securities of any issuer. The remaining 25% can be invested in any manner. Note that the 5% limitation only applies at the time the assets were invested. If the investment grows to more than 5%, it does not have to be reduced. The cover of the prospectus also refers to another document called the Statement of Additional Information. This contains additional details that not all fund investors may be interested in. The statement may be obtained free of charge by calling or writing the fund. Also on the front cover of the prospectus in bold print is a statement called the SEC Non-Approval Clause. It warns investors that the SEC does not vouch for the accuracy or adequacy of any statement in the prospectus. Any claim made by a registered representative to the contrary is a violation of the national securities law. Inside the prospectus is information that every potential investor should examine. Just inside the cover is a series of tables that disclose information about the charges and expenses of the fund. The first table that we will examine contains information about shareholder transaction expenses. These are charges assessed when investors purchase or redeem shares. Here's an example of what such a table might look like. The first line indicates whether there is a front-end load, that is, whether there is a sales charge imposed at the time of purchase. In this example, there is a maximum sales charge of 5% of the public offering price. The table would also indicate where the sales charges are assessed on reinvested dividends, whether there is a deferred sales charge or redemption fee, and whether the fund assesses a charge for exchanging shares of one fund for another. Often the exchange charges are minimal or zero. In addition to information about transaction charges, the expense page also shows annual charges assessed for operating expenses. Here's an example of what such charges might consist of. The first charge is for the management fee earned by the investment advisor. In this case, it is 0.6% of the fund's average assets on an annual basis. This fund also charges a 12b-1 fee, which is indicated on a separate line. Other expenses amount to 0.15% of fund average assets. These charges include legal and accounting fees and general overhead expenses. Since funds can charge so many different kinds of expenses in so many different ways, the SEC requires that each prospectus contain a table that compares the expenses paid by a hypothetical shareholder over a period of time. All funds must use the same format. Total expenses that would be paid after 1, 3, 5, and 10 years are given. The example assumes an initial investment of $1,000 and a 5% hypothetical return. The prospectus must point out that the example does not represent the actual performance or expenses of the fund. Another table published close to the front of the prospectus contains a condensed statement of financial information about the fund. The information covers either the last 10 years of the fund's history or the life of the fund, whichever is less. For each year included, the table shows the beginning and ending NAV for the fund, the net investment income for the year, net gains and losses on securities transactions, dividends and distributions paid by the fund's total return for the year, and key fund ratios, specifically the ratio of expenses to average net assets, called the expense ratio, and the portfolio turnover ratio. The latter gives us an idea of how frequently the fund manager trades securities in the fund's portfolio, while the expense ratio tells us how efficiently the fund is being run. The total return of the fund includes returns from dividends and distributions, as well as changes in net asset value. After the table of financial information, the prospectus usually discussed some general features of the operation of the fund, such as special investment techniques used by the fund. Such investment techniques may create an increased risk for the fund. The prospectus also describes any investment restrictions under which the fund operates. Generally, the Investment Company Act of 1940 prohibits funds from purchasing securities on margin, that is, on credit, or selling stock short, which requires borrowing securities. In addition, mutual funds may not participate in joint trading accounts. The prospectus also describes the manager or investment advisor to the fund and describes the fees paid to the manager. Investors who wish to purchase shares will consult a section of the prospectus on how to buy shares. This section will describe which of several possible distribution methods is used by the fund. The fund might distribute its shares through a sponsor or principal underwriter who works through a group of dealers. Some sponsors distribute their shares directly to the public, and in some cases, investors can buy their shares directly from the fund. This would be a no-load fund. Most mutual funds impose a minimum requirement on the amount of the first investment. After the initial investment, subsequent investments may usually be made in smaller increments. The prospectus also usually describes the time by which the orders must be submitted in order to receive the next offering price calculated. Most funds calculate their NAV once a day at the close of trading on the New York Stock Exchange. Many mutual funds that charge sales loads offer breakpoints, which are described in the section on how to buy shares. Mutual funds also have plans to allow investors to purchase shares automatically. Some funds, for example, will automatically deduct a specified dollar amount from an investor's checking account periodically, usually once a month. By doing so, an investor is using a technique called dollar cost averaging. The basic principle behind dollar cost averaging is that the investor purchases the same dollar amount of the fund shares on a regular basis, regardless of the fund's cost per share. For example, suppose an investor is going to invest $60 per month. At the time of the first purchase, the fund is selling for $4 per share. The investor, therefore, will have purchased 15 shares. The next month, the investor again purchases $60 worth of shares. But this time, the offering price is $5 per share. So 12 shares are purchased. When the next $60 is invested, the price has fallen to $3 per share, resulting in a purchase of 20 shares. Notice that more shares are purchased when the purchase price per share is lower. The final purchase in our example is at $6 per share, resulting in only 10 shares purchased. After 4 months, a total of 57 shares have been purchased. To calculate the average cost of these shares, the total amount paid is divided by the total number of shares purchased. In this case, the average price is $4.21. Contrast this with the average of the purchase prices per share paid, which comes out to be $4.50. When dollar cost averaging is used in a fluctuating market, the average cost of the shares is always less than the average of the prices paid. Of course, this does not guarantee that the investor will make a profit. The shares could become worthless. But it does mean that the investors will have purchased more shares when they are cheaper and fewer shares when they are expensive. Every mutual fund prospectus also contains information about how to redeem shares. Before redemption can be processed, the request must be received by the mutual fund in good order. That is, the request must meet all of the requirements laid down by the fund. In some cases, redemption can be done by calling a broker or by writing a check. In other cases, the fund may require that the investor write a letter to the fund. These letters might require a signature guarantee provided by the member of the New York Stock Exchange or a commercial bank. This section of the prospectus will also indicate whether the fund charges a redemption fee. The prospectus also describes whether the fund allows exchanges among funds of the same family, an activity that is sometimes called switching. For example, suppose that XYZ fund is part of a family of 4 funds. An investor wishes to move an investment from the XYZ fund to the XYZ government bond fund. This is considered to be the sale of the shares of XYZ fund and the purchase of the shares of XYZ government bond fund. At the end of the year, the investor will receive a 1099-B reporting the sale of the XYZ shares and will have to do a capital gain or loss calculation. This means that an exchange is a taxable event for the investor. In most families of funds, the exchange can be made without incurring a new sales charge on the second fund. However, there may be some type of fee assessed, especially if the investor has already made several switches recently. Our hypothetical fund has no charges for exchanges, information that is found in the shareholder expense transaction table. For the convenience of investors, many funds offer automatic withdrawal plans, which redeem shares on a regular basis for investors. They can be set up in a variety of ways. An investor can request that a fixed dollar amount be sent to them each period. Enough shares are redeemed to provide that amount. Another choice involves redeeming a fixed percentage of the account each time. As an alternative, the fund will redeem a fixed number of shares each time. Some funds will even redeem in a manner designed to liquidate the account in a specific period of time. However, a registered representative must be careful not to represent these methods as being like an annuity, since the account could be exhausted at some point. In addition to the prospectus, there are several other sources of information about specific mutual funds. Each fund must send shareholders 2 reports per year regarding the operation of the fund. These semi-annual reports must contain a discussion of the fund's performance for the last 6 months and a list of the investments in the fund's portfolio. Another source of information is advertising and sales literature prepared by the fund or its principal underwriter. Independent information and evaluations can be obtained from several research services that specialize in mutual funds. These include Lipper Analytical Services and Morningstar. Other services include Value Line, which also has reports on closed-end funds. Mutual fund tables in certain newspapers also contain current prices and sometimes performance information for many funds. When recommending funds to clients, a registered representative must have a reasonable basis for believing that the investment is suitable for the customer. In order to comply with this requirement, registered representatives must know something about client objectives, type of risk, and the characteristics of particular funds. There are several types of goals that clients might have. These include preservation of capital, where the main concern is safety of principal. Another goal is income, such as retirement needs. Many long-term investors look for growth or principal or capital appreciation as a primary objective. Investors in high tax brackets often are looking for tax-exempt income. Other investors may be planning for future cash needs, such as a college funding program. Registered representatives should also be familiar with the types of risk that specific investments might have. For example, bonds and bond mutual funds have various degrees of credit risk, the risk of default on principal or interest payments. U.S. government bonds have virtually no credit risk, while junk bonds have a high degree of credit risk. Bond funds also exhibit interest rate risk, the risk that rising interest rates will depress bond prices. Mortgage-backed securities, such as Ginnie Maes, have prepayment risk, which is the danger that principal would be repaid just as interest rates were lower. Fixed income investments in general are subject to purchasing power or inflation risk. Future payments that are fixed will not buy as much as they will today because of the effect of inflation. All investments are subject to timing risks. We may make an investment at the top of the market rather than when prices are low. Many investors are concerned with marketability or liquidity of a security. This refers to the ability to quickly sell a security at a price closely related to the market value. An investor who quickly tries to sell a significant amount of a less liquid security often has to accept a substantially lower price. Taxability risk represents the danger that an investor's tax status will change, increasing his or her tax liability. This could occur because the investor's income increases or because of tax law changes. Market risk refers to the fact that general declines in the market could affect the value of all investments. This danger is also known as systematic risk. There are frequently situations in which unforeseen political events can affect the value of investments, especially foreign securities. This is political risk. Investments in foreign securities can also be affected by fluctuating exchange rates, which is called exchange rate risk. Once we know something about general clients' goals and the risks of various investments, we can find a mutual fund to fit the client's needs. There are many types of funds available. For example, there are several types of funds that invest in common stock. Growth funds invest in fast-growing companies whose share prices are appreciating at above-average rates. However, such funds produce little dividend income. Those investors who want common stock fund that produces significant dividends would favor income funds. Such funds purchase stock that pay generous dividends, such as that of utility companies. Option income funds attempt to increase return by writing covered calls on their stock portfolio. Growth and income funds try to strike a balance between capital appreciation and dividend income. The stock investments made by an index fund attempt to mirror the composition and performance of a specific stock index, such as the Standard & Poor's 500. Since the composition of the portfolio is set, the management fee for an index fund should also be set. In addition to common stock funds, there are a wide variety of bond funds available in the mutual fund market. The type of fund is often described on the basis of the dominant type of bond in which the fund invests. A government bond fund primarily invests in Treasury securities, although some may contain government agency securities as well. One would expect to find Ginnie Mae pass-throughs and similar investments in a mortgage-backed securities fund. Funds that invest in corporate bonds are often classified even further by the quality of the bonds in the portfolio. Investment-grade funds buy bonds in one of the top 4 bond categories. High-yield funds invest mainly in bonds below investment grade. Although their returns can be high, they are more volatile and have a larger amount of credit risk. Investors seeking tax-exempt income choose municipal bond funds. To obtain tax exemption at the state level as well, investors in some states can choose bond funds that invest only in municipal bonds from their state of residence. Some funds invest in a combination of stocks and bonds. Balanced funds usually invest in a fixed proportion of each, such as, let's say, 60% stock and 40% bonds. Asset allocation funds invest in stocks, bonds, and cash, that is, money market instruments. However, the manager has freedom to vary the proportion of each according to market conditions. For example, an asset allocation fund manager might have 60% of the portfolio in stocks, 30% in bonds, and 10% in cash at a particular point in time. If the manager believes that market conditions are about to weaken, he or she might make a defensive move and shift to a portfolio of 10% stock, 20% bonds, and 70% cash. Some funds invest exclusively in short-term debt instruments with the objective of preserving investors' capital. These are the money market funds. They can be further divided into taxable and tax-exempt funds. The tax-exempt funds invest in short-term municipal securities that produce interest that is federally tax-free. There are a variety of funds that make specialized investments. These include funds that invest in just one industry or a sector of the economy. For example, a fund might invest in just computer technology stocks or the retailing industry. Other funds might invest just securities of companies in bankruptcy. Now, this would be a special situation fund. Many investors recognize that other countries have economies that are growing faster than ours. Foreign security funds allow easy access to those growing markets. Funds that invest in companies throughout the world, including the U.S., are called global funds. Those that invest exclusively outside this country are called international funds. We have been looking at issues related to selecting the proper fund to meet a specific need. Registered representatives must have a reasonable basis in believing that recommendations made to customers are suitable. This is one of the rules of the National Association of Securities Dealers. The NASD is the self-regulatory organization for the over-the-counter markets, including mutual fund transactions. There are several other NASD rules that affect mutual fund transactions. Some of the most important NASD rules that affect mutual funds are those covering advertising and sales literature. Advertising is information not directed to specific individuals that appears in the public media, such as newspapers, magazines, radio, television, and the Internet. Sales literature is any other type of soliciting material. All advertising and sales literature must be approved by a principal before first use. A principal is a manager who is licensed to supervise registered representatives. The broker-dealer must keep the material on file for 3 years after each use. In addition, to be filed within the preparing broker-dealer, investment company ads must be filed with the NASD within 10 days of first use. Other types of ads must be filed with the NASD 10 days in advance for the first year of advertising. Although the SEC has several specific types of requirements relating to advertising, any material filed with the NASD is considered to have been filed with the SEC. As with all recommendations within advertising and sales literature must have a reasonable basis. Additional NASD rules apply to the relationship between the sponsor of the mutual fund and the fund's dealers. First, both the sponsor and the dealer must be members of the NASD. Second, there must be a written agreement between the sponsor and the dealer. NASD rules do not allow special deals, that is, special sales concessions to the dealer that are not disclosed in the prospectus. In addition, dealers may not purchase mutual fund shares for their inventory and later resell those shares to customers. Orders from customers are filled with shares purchased that day. NASD rules also describe the procedures determining who is going to receive an upcoming dividend. In this process, the company paying the dividend announces a payable date. This is the date that dividend checks will be mailed to shareholders. The company also announces a record date. This is the date by which an investor must become a shareholder in order to receive dividends on the payable date. Generally, an investor must settle a trade by this date in order to receive the dividend. A third key date is the ex-dividend date. As of this date, investors purchasing shares will not be eligible to receive the upcoming dividend. Investors must purchase shares prior to the ex-date in order to receive the dividend that will be paid. Mutual funds are subject to special rules regarding the ex-dividend date. The sponsor of the mutual fund determines the ex-dividend date. However, most sponsors select the record date itself as the ex-dividend date. It is important to understand how the ex-dividend date affects the price of shares. Suppose that a mutual fund is going to pay a dividend of 50 cents per share. But just prior to the ex-date, a share is selling for $20. Assuming no change in the value of the securities in the fund's portfolio, what will happen to the share price on the ex-dividend date? It should drop by the amount of the dividend, since purchasers will no longer receive the upcoming dividend. Some investors believe that it is to their benefit to purchase shares prior to the ex-date, when in fact they are better off waiting until the ex-date to make their purchase. The unethical practice of encouraging clients to purchase shares prior to the ex-date is called selling dividends. This practice is prohibited by NASD rules. Another sales practice that is prohibited by NASD rules is breakpoint sales. This is a sale of a mutual fund to a customer in an amount just below the point at which a lower sales charge would be granted. The NASD also prohibits churning, which is the practice of executing trades for customers that are excessive in size or frequency. That concludes our discussion of investment companies. For more information on other study materials, please call STC at 1-800-STC-1223. Thank you for joining us.